Here he is. Hi, Roby. Let's see here. Can you hear me, Roby? Whoops. Hold on here.
I can hear you, Bob.
Oh, how we doing? Hi, Natalie. How you doing there? We got Natalie, Roby. Hi, Riley. How you doing? You guys need to unmute. Unmute.
Can you hear us now?
Now I can hear everybody. Hear me, Natalie?
Yes, yes.
Hi, Roby. Can you hear me?
I can. Can you hear me?
I now can, sir. And how's Riley doing?
I'm good.
All right. We had 3 good scores on the test, huh? That test was not exactly a buzzsaw, but at least it brought up all the elements we need to understand. And I'm really glad to see how well you did, huh? We're into chapter 4. So here we're learning to do journal entries, right? You've been doing some of the assignments so far?
Yeah.
Journal entries. Journal entries. That's the method in which we update the general ledger. Can you see this screen now? Can you see the PowerPoints?
Yes.
Yeah.
Okay, here we go. Hopefully we don't lose them. Oh, it's Alyssa Milano's birthday, huh? I just found out. Here we go. Let me get this thing going into the bigger mode. Okay, so let's go through the PowerPoints and then afterwards see what kind of progress we made and if we have any questions or concerns, huh? This chapter here talks about adjusting journal entries. Adjusting journal entries, and that's something that students find a little tricky at first. Let's see what happened here. Oh, for heaven's sake, how did I make that so big? Oh my goodness. Forgive me, guys. It's an early Monday, I guess. Hold on. All right, here we go. Adjusting journal entries. They can be tricky. They are common to all companies. They are basically a search for unrecorded expenses and maybe a couple of revenues. They can only be done at month end, and they are internal entries in that they don't affect other companies or other people. They are very important to prepare. And so let's see if we can get going here. Well, we know management is responsible for those financial statements which are useful to the entire world. Relevance and reliability. And here we go. Here's a good look at the accounting cycle, huh? During the month, you're sitting in your office, you're opening the mail, you're looking at a bill. That could be called analysis. People have been working, you're going over the payroll, you're doing all kinds of analysis, and then you record a journal entry. That journal entry will automatically update your general ledger. No matter what kind of a computerized accounting system you have, as soon as you tell your computer system, this journal entry, which I just entered, post. You hit the word post, woof. You have now updated your general ledger for all eternity. You cannot erase it. It's there forever. The only way to correct it is to reverse it and then do it correctly. So you've been doing this all month, huh? We've been putting in the electric bill and insurance, and we've been buying things, selling things. We had a good month selling. We bought a bunch of stuff. We made investments. The end of the month comes, and now we have to adjust our revenues and expenses. And I'm going to say mostly expenses. And we're going to do that with adjusting journal entries. Typically, a company's month ends, say, on the 31st of October, for example. And then that company might have a policy where they've got 3 or 4 days to prepare the adjusting journal entries. So you're working November 1, 2, 3, 4, but when you're posting it, you're telling the computer that you're still in October. So that's what the closing period is about. You adjust, and then you prepare your statements, disseminate statements. Boy, that's a fancy word, it means giving them out. You disseminate the statements, and then you can take a deep breath because you're pretty much done. The only thing left is to close the revenues and expenses and any gains, losses, and the cycle starts again, huh? Purposes of the adjustments. Revenues are recorded when earned, as we know, and expenses are recorded when incurred, when they take place. Transactions occur over time. The end of the month, you must figure out what revenues you've earned but not recorded, and same thing with expenses. Because transactions occur all the time, companies wait until the end of the period to adjust these accounts. You could theoretically do these daily, but that would be a terrible waste of time, okay? You're gonna wait until the end of the month to adjust. A good adjustment would be for supplies. You had $1,000 in supplies at the beginning of the month, you have 200 left at the end of the month, 800 is what you used. You're not going to go and every day take a pencil out and write a journal entry. You're going to wait till month end. This grid here is a really good one. And I'm going to go over this a little bit, and then we'll go through some good transactions, I believe. Types we have deferred and accrued, okay? Deferred and accrued. Deferred revenue, unearned revenue. Let's start with just the basic categories. Deferred. A deferred is, I'm going to give you the Bob Smagula definition before this. A deferred expense or a deferred revenue means money has changed hands, but nobody's done anything yet. I'll repeat that. Deferred. Money was paid in advance, but nobody's earned the money yet. Previously, deferred, let's start with deferred revenues. Oh, I don't like the way this is. I'm going to interrupt myself for 1 second. Deferred revenues. Okay. A deferred revenue. This is called unearned revenue. Deferred. You received the money in advance, but you haven't earned it yet. When I sent the Dodgers money for season tickets a couple of years ago, they got the money in February and they debited cash, but they could not credit income. They could not credit sales. They could not credit ticket revenue because they had not earned the money yet. So when they got the money, that is a debit to cash, and the credit is to a liability account, huh? A liability account called unearned revenue. It's a liability because the Dodgers owed me baseball. And then once they started playing games, then they could debit that liability and record revenue. A deferred expense. Now, this one's the much more common thing we're going to talk about. A deferred expense is a prepaid expense. And you know a little bit about prepaid expenses now. Prepaid expense, prepaid rent, supplies, insurance that were created. Cash was paid in advance, huh? A deferred expense. Guess what? A deferred expense is the same thing as a deferred revenue. It just depends what side of the transaction you are on. For example, deferred expense. On December 29th of last year, you bought an insurance policy and you paid $12,000 to cover you the following year, this year. You spent the money in 19 to cover your business throughout 2020. Okay, so when you spent that money, you credited cash and you debited an asset account called prepaid insurance. That is an asset. Prepaid insurance. You have a policy that's worth $12,000 to your company, and you haven't gotten any benefit out of it yet. It is an asset. The company that received your money, they didn't credit cash, they debited cash, and they credited unearned revenue, perhaps unearned insurance revenue. And as the new year begins, after 1 month, you, the person who bought the insurance policy, now have the benefit of $1,000, right? $12,000 policy over the year. $1,000, your adjusting entry will be a debit to the expense, insurance expense, and a credit to the asset, prepaid insurance. Here, it's the opposite. This guy is going to debit the liability and credit the income. Deferreds, I'm going to say it one more time. Deferreds means money changed hands, but the service was deferred. The activity was deferred till later, okay? Deferred money changed hands. Let's talk about the accruals now, the accrued revenues and accrued expenses. I'm going to start with the accrued expenses. These are going to make up the bulk of your adjusting entries. Accrued expenses, they are incurred but not recorded because cash is going to be paid after the goods and services were used. And there are all kinds of things here. One example I'm going to start with is the telephone or the electric bill. The month ends on December 31st, and your responsibility is to get the financial statements prepared and out to the public in 10 days. But you're not going to get an electric bill from your carrier for probably 20 days. So you must accrue an expense. You must, and God forbid the word, you must estimate a number, and that's perfectly permissible under GAAP accounting. You have to estimate a number on what they call a systematic and rational basis. Here in California, where the weather doesn't change much, well, the electric bill's been running since January, let's see, 500, 520, 510, 480. We could probably get away with accruing $525. So you're going to debit that expense, and you're going to credit an accrued payable account. Accrued revenues, what we're talking about here, everybody, is essentially interest income. You loaned me $1 million at, say, 12% a year. The first year ended, and I now owe you 12% interest, or $120,000. But I don't have to pay you till maybe another 2 weeks. That's the deal. So as soon as that year ended, you recognize that I owe you interest. Your accrued revenue will be a debit to interest receivable and a credit to interest income. So that might be an overlong look at the types of adjustments. Deferred, new money, changed hands, accrual. I'm sorry, deferred money did change hands. The accrued, something's happened, we must recognize. 3 steps, huh? Was revenue earned or an expense incurred, not recorded? What cash received, paid in the past? I'm not sure how useful this is. Was revenue earned or an expense occurred that is not yet recorded? Well, that's the whole point we're trying to understand here. Yes. Was the related cash received or paid in the cash, or paid in the past? Or will it be received or paid in the future? These are sort of quicker definitions of the deferred and accrued word. Compute the amount of revenue. Okay, now we're going to get into some transactions here. And I hope when we get done shortly, you have a pretty good sense of what the adjusting journal entries are about. And you also have a little bit of a confidence going here, huh? Revenue, when cash is received on the date the revenue is earned, huh? Well, this is what we learned right in chapter 1, I suppose, huh? Chapter 1 and 2. Cash is received at the same time as the revenue is earned. You ordered pizza, and the pizza guy came, and he said that'll be $20, and that's the transaction. The pizza guy got cash, $20, And the revenue is recorded now. He delivered the pizza. He delivered the pizza. Same time. No adjustment needed, huh? Let's see what we have here now. Unearned revenue. If cash is received before the company delivers the goods or services, the liability account comes into play. When the company delivers the goods or services, then the revenue is recorded. So here we go. We're an insurance company and we just sold an insurance policy. We debit cash and we credit unearned revenue. And yes, we're going to have to make an adjustment every month for 1/12 of that insurance policy, huh? Revenue. Guess what? The money can come afterwards. And this is most of the world's transactions. If cash is received afterwards, well, we're going to put the sale into accounts receivable and credit revenue. We know that already. It says yes, an adjustment is needed. That's a bunch of baloney. There's no adjustment. What they're doing here, guys, is they're calling the cash payment later an adjustment. This is simply foolish. You debit accounts receivable and you credit sales or revenue, and then you get paid later, okay? That is not an adjustment. They're just calling it that for God knows what. Here we go. Let me get back up here. Revenue. Matching principle. Let's understand the matching principle. What are we matching? Revenues and expenses. And I guarantee that'll be a question on a future test because it's so important. The matching principle. We match the revenues with the expenses that were incurred during that same period. The matching principle. And that's kind of what we're doing here with the adjustments. And what they're saying here, when cash is paid on the date the expenses incurred, well, no entry, okay? We called in a guy to fix the copy machine. The guy came in, he fixed the machine, and he handed us a bill and said, pay me now. Expense. The revenue matched that month's revenues. We were earning revenues that month, and part of the expenses involved were that transactions. Here is the prepaid expenses. And these are kind of easy when you do a few. If the cash is paid before we receive the service or goods, an asset account is recorded. Prepaid expenses. Prepaid expenses. As soon as you see prepaid rent, you know your adjusting entry is going to be rent expense. If you see prepaid supplies or supplies, you know your entry is going to be supplies expense. That's matching them up, right? When the expense is incurred, then we reduce the expense and record the expense. So here we go. We bought that famous insurance policy. That changes supplies. That will be wild here. We bought supplies, what your book calls supplies. We bought supplies and we paid cash. But we took all of those big truckload of supplies and we put it in a room and we haven't used them yet. So it is an asset. It's prepaid and we haven't used it. Well, look what happened. At the end of the month, that $10,000 of assets of supplies we bought, we used some of them. So if cash is paid after the company receives the goods, payables recorded. This is the same thing with the accounts payable, receivable. I am going to skip that. Come on. We got one more I want to see here. Okay. They're calling this an adjustment. It's really just the cash payment. And the faculty's kind of going over this one. We need to just clear that one up. Come on now. Types of adjustment. Okay, we're back into types of adjustments, and we have revenues and expenses. I'm going to start with expenses. This is 90% of what we're talking about. Expenses. Your prepaids. Prepaids are deferreds. Money changed hands. It's the action that's deferred. This delivery. The performance of the work is what's deferred. And a prepaid expense, one man's prepaid expense, is another woman's unearned revenue liability. You bought an insurance policy, you credited cash. You received the money, you debited cash. You debited an asset, you credited a liability. They're the same thing. Accrued revenues and accrued expenses. Accrued expenses can be anything from your utility bills to your payroll, whatever expenses you incurred that you have not paid for or recorded. Another good example might be repairs. Oh my goodness, the last day of the month, the toilet backed up. We had to get a plumber in here. He charged us, he's going to charge us X amount of money. We have to accrue that. And this is pretty much the same thing we were looking at earlier, the deferreds and the accruals. You notice how they're really pounding this in, the basic 4 types of adjustments, huh? Accrued revenue. Accrued revenue. What we're talking here is interest, 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 interest. Unearned revenue. Customer paid us in advance. You go to a lawyer. You go to the lawyer, you hand him money. He hasn't done anything yet. That's unearned revenue. And here are the other 2. Here what they're doing, guys, is they're breaking out the adjustments into the revenue side right here, and then the expense side. The expense side, you accrue salaries, interest, all kinds of things, prepaid. So here we go into the next little area, huh? The month is ended, and you've done everything you can to record everything you possibly can. And you've gone through your trial balance, and you see that it balances, first of all. And you're going to go back and check every item on that trial balance and make adjustments if necessary. So the trial balance is just what we talked about earlier. It's a listing of your accounts, always, not usually, always in asset, liability, equity, revenue, expense order. And the debit columns are separate, and they must balance. They must equal. So here we go. Chipotle, huh? Chipotle. Unadjusted trial balance. The month just ended, right? And I see Chipotle here. And we're looking at this. We know it's unadjusted because they're telling us. That means that they have to write adjusting entries. It's impossible to avoid them. They are there. For example, look at the wages payable. I don't see a number there. There pretty much has to be a wages payable number. We don't pay people in cash too much anymore. If I look down here, I don't see any depreciation expense and all kinds of things. So perhaps, maybe we have to write adjusting journal entries. Oh, Jesus, we're back to the 4 kinds of entries again. Yike. Okay, here we go. Now we got some good stuff going finally, huh? We're going to look at Chipotle. I'm going back to Chipotle's real quick. So we're going to look at this trial balance, and we're going to look at the cash. You never adjust cash. Believe me, you never adjust. But supplies, we know we use supplies. And I look down here, and I don't see any supplies expense. So we know we have some adjusting to do. And we know there are 4 kinds of adjustments. Okay, they're going to start us off with accrued revenue. Accrued revenue. And when we say accrued revenue, we're pretty much talking interest income. Chipotle earned, let me move this down just a little, there we go. Chipotle's investments earned an additional amount of $200 during the quarter, but they're not going to get paid for another 12 months probably. So that's money they've earned. they're going to probably record that as a receivable and record the revenue. $200 of interest during the quarter. $200 of interest. If I may, with a little smile on my face, go back up here briefly. Chipotle has $543 million in cash, right? That's what that is with the 3 zeros. And they only earn $200 of interest. Anyway, that always makes me chuckle. Not a very good investment, whatever it was. So here we go. The investment, we're going to debit interest receivable. So now interest receivable is correct, $200. And the interest revenue, which was $1,200 during the month, there were some other investments where we did pick up the revenue. We now have $200 there. So there's your journal entry. Interest receivable, interest revenue, or interest income, okay? They earned this interest during the quarter, but the cash isn't coming from the borrower for a while. Deferred revenue. Here we go. This is the unearned revenue. I always, as a big sports fan, I always use the Dodgers or Yankees, somebody as my example. But I'm going to be a little bit sexist. We're talking about gift cards at stores now. We all like to shop. I know I do. Anyway, you go to Nordstrom's and you buy a $100 gift certificate from the store. And then you walk out without using it. Well, Nordstrom's now has money, cash, but they haven't earned any of it yet, right? Because you've not bought anything. So what will our journal entry be? When customers redeem their gifts during the year, Chipotle provided food service in the amount of $17,300. Here is the amount they actually paid out in terms of food. People came in and used $17,300. There was 38,000. Here it is here. There were $1,701,000 still unclaimed. So here we go. You're going to debit unearned revenue, which is going to decrease the revenue with the debit, and your restaurant revenues are going to go from $1,701,000 up another 17. The $1,717,000, I am assuming that's what the cash register payments were, huh? Look at your journal entry. Debit the liability. Unearned revenue is a liability. Credit the revenue. Anybody have any questions thus far? Anything you think I'm skipping at this point? Good to go? Guess what? There are 4 kinds of adjustments. Jesus. Deferreds, accruals, and the revenues, expenses. Deferred expenses. Here we go. Here is, you're going to have a lot of these to work on. Prepaid rent, prepaid advertising, prepaid insurance, all kinds of things. Rent and other prepayments expired. Be sure to read the question correctly. I'm pretty sure after you do a little bit of homework, these prepaid journal entries are going to be pretty simple. But read the problem. Various insurance, rent, and other things expired. Expired means dead, right? Expired means used. That is the expense, not the balance at the end. They like to trick you with that, okay? That's how much they used of this prepaid. So how much was there before? There was 150,000 there. And now they've used 93,400. You credit the expense, right? And you debit the prepaid. You debit the prepaid and you I'm sorry, you credit the prepaid and you debit the expense, okay? So this prepaid insurance or whatever had a balance of 150 on our trial balance, and now we've adjusted it down to 56, and we're increasing the commensurate expense, whatever it might be. Journal entry. I'm assuming insurance expense, you debit insurance expense, rent expense, credit the prepaid. Okay? Anybody have a question on that one? Seem pretty clear? Here we go. Supplies. We have another prepaid, huh? Prepaid supplies. Supplies were used during the quarter to generate revenue, but no entry's been made to record the amount used. $16,100 worth of supplies are remaining on hand on March 31st, 2017. You see what I'm saying about the wording? The prior problem, they gave you the expense. Here, they are giving you how much is left in the supplies account. We only have 16,100. How much did we have to begin with? Wow, they had $385,000 worth of supplies. And then at the end of the month, they only had 16. They used a ton of supplies. So now we're going to record that amount. What's our journal entry? I bet we're going to debit supplies expense and credit prepaid supplies. Do we all know how we got that number? We had 385,100 to begin with, and now we used 369. That leaves us with a tiny balance, huh? That's a lot of straws and napkins, huh? At Chipotle. Okay, they're still talking about deferred expenses, but this is the easy one. Here they're talking depreciation expense. We know what we should know. Well, I shouldn't say that. Let me back. Depreciation expense is an easy one because you're always debiting and crediting the same account. You're going to debit depreciation expense, and you are going to credit accumulated depreciation. They owned this much in buildings and equipment, and at the end of the period, they must record rather the depreciation expense. And they've determined that that amount is 30,600. Okay. Look at the journal entry. You debit depreciation expense and you credit accumulated depreciation. I've got the guitar right here, and I'm not going to use it because you've been a good audience, but I used to sing that song. You always debit depreciation expense, credit accumulated depreciation. And the song goes, you never credit the original cost of the asset. And we'll get into that. Here we go. This is probably the biggest part of your adjusting journal entries. Accrued expenses. Companies have tons and tons of accrued expenses, huh? Accrued expenses, rent, interest, and wages. Now, I bet we've all been out in the workforce, huh? As of 3/15/17, in other words, we're in the middle of the month. As of the middle of the month, Chipotle had already paid $177,000 in wages for the year or for the month. Okay, so that's done already. That's the current expense. But now people worked from the 16th of the month to the end of the month. Chipotle pays every 1st and 15th. So the people who worked from 3/16 to 3/31 at the end of the month, they're not going to get paid. They get paid the next month. Chipotle pays its employees every 1st and 15th. Next payday, April. So they earn those wages for the last 2 weeks of March. The last 2 weeks of March. And you remember we saw no wages payable on the trial balance. I mentioned that. Now we will, because we say to ourselves, you four guys You worked for me for those last 2 weeks, and this is how much money you earned. Here is your journal entry. Debit wages expense and credit accrued wages payable. I prefer to see the word accrued there, but that's okay. Debit wage expense, credit accrued payable. You earned that money during March. And it was during March that the company earned revenues. We have now matched this expense with this revenue. Okay? Accrued expenses. Chipotle owes $287,900 in long-term notes payable, right? And they bear interest. For the first quarter of the year, $200 worth of interest has accumulated. Hey, Roby, you're a business person. Wouldn't you love to borrow almost $300,000 and only pay $200 a month interest? Doesn't
Yeah,
seem very.
pretty good deal.
That's the deal of the century, ladies and gentlemen.
I guess it might be these days. Interest rates are so low.
Oh my goodness, I'm so sad you mentioned that because you're reminding me. Yeah, you're absolutely right. Yeah, if interest rates are below 1%, but that would still be 28.79. It would still be a mold. You know, I might not be laughing at this. You're right. If things keep crashing, Jesus. So we have to record $200 worth of interest expense. $200 worth of interest expense. There we go. Interest expense. And this entry, I'm assuming, is made every month during the year. You're going to do this every month, and then you're going to get a payment from the borrower. So let's go back to our our unadjusted journal entry, okay? The one where we noticed we didn't have any wages expense, we didn't have any supplies expense, we didn't seem to have any accruals on this thing. Now we've recorded all those transactions. Okay? And now they're giving us a hint. Here is the same trial balance, and they're giving us a hint. We got to fill some things in. Let's post all of those journal entries. Voila, there it is. Let's take a look. Remember, we had to accrue that famous $200 worth of interest. We debited interest receivable for 200. We credited interest payable for 200. The supplies. The supplies were excuse me, $385,000. We used 369, and now we're down to 16.1. There's the 369, etc. Now what we've done is we've posted all of these journal entries, and we ran a final adjusted trial balance, adjusted. Now we're ready to bless this trial balance and say it is accurate as far as we know. As far as we know, this trial balance is perfect. And now this trial balance becomes the worksheet, and that's all it is, a worksheet to prepare the financial statements. We can do the income statement right now in 2 seconds. Go to your retained earnings, draw a horizontal line here. Everything below this horizontal line is your income statement. Everything above is your balance sheet. And all you're going to be doing is copying these numbers into whatever your statement format looks like. So now we've prepared this beautiful, accurate, balanced trial balance. We did a lot of work on this. Sometimes you need to work a lot of extra hours to get all this done in a short time. So what do we do now? Now we get myself lined up. Now we're ready to prepare the financial statements, and they must be prepared in this order. You must do the income statement first, then the statement of equity, then the balance sheet. And we're not going to worry about the cash flow statements. The income statement, that's simply your sales minus expenses. Income statement, sales, revenues minus expenses. We do the income statement first because we know that net income is going to increase equity. Every time you sell something for a profit, you've increased equity. And that's what we're recognizing at the end of the month. Our sales were this number minus our expenses. That net income is now going to be closed into equity. So you must do the income statement first. Then you can prepare the equity statement. The equity statement. The equity statement is going to be your beginning. It's going to be whatever your beginning balances are, plus the income to get the final equity amount. At the beginning, you had this guy, Chipotle, invested $1 million in his company, and now he earned some more money, so the equity grew. Once you have the equity number, it gets even easier because now you can do the balance sheet. And all you're going to do is copy every number from the trial balance except one. What was the only number that changed? The retained earnings, because that is where we took the income. At the end of the month, these expenses and revenues are zeroed out and moved into equity via a portion of equity called retained earnings. Now, at that point, we can take a deep breath and we're done. Boy, that was tough getting all those adjustments done. We got the statements out. Everybody's happy. The only thing we need to do now, though, is close the income statement is what I'm trying to say. Close the income statement. Even though the balance sheet accounts balances carry forward from period to period, the income statement amounts don't. They disappear. They become a zero balance at the end of the month because we are moving that revenue and expenses, in other words, net profit, to retained earnings. And so at the end of the period, you are going to do closing entries. And what do we close? Revenues, expenses, gains, and losses. What do we close? The income statement. Those types of accounts are called temporary accounts, temporary, because they're going to be zero at the end of each month. Becomes zero and used to increase the equity of the business. I like this grid here. This makes a lot of sense to me. And this is really the way I'd like you to process this. Closing. Close the revenues separately from the expenses. Close the revenues. Close them to retained earnings. Then in a separate journal entry, close the expenses. Close the revenues. Revenues have a credit balance, right? So if you have sales of $100, you're going to close that with a debit and credit retained earnings. The opposite with the expenses, which have a debit balance. You credit all of your expenses and debit retained earnings. So the entry to close the revenue, remember they had two revenues, right? They had the cash register and they believe they had some interest income, right? Here we go. This is the before we close. How are we going to get rid of this revenue? We are going to debit that. How are we going to get rid of this revenue here? Debit, and what are we going to credit? Retained earnings. Look at the journal entry. Closing. You debited all your sales, revenues accounts. You credited retained earnings, which is part of equity. There we go. Wow, the business grew. We had a business that was worth $1.7 million. Wow, now it's worth $1 million, was it 2,718,000, but we have not closed the expenses. So when they said do it in two parts, that's easily the best way to do it. We've closed the revenues. Now we got to do the expenses. If we were to close the temporary accounts, the entry to close expenses would be. And if we look back, we could say to ourselves, well, let's see, what did we do here? I remember we had depreciation expense. We had that $200 interest expense. We had some other things. So what we're going to do is we're going to debit every expense balance. Debit, debit, debit. And credit every wages expense. Credit every expense, debit the retained earnings. I'll allow the grid to carry me forward through here. If we were to close the temporary accounts, what would we do? We credit wage expense. That balance is zero now. Credit, credit, credit. You credit all of the expenses and you debit retained earnings. Not too tough, but students tend to get a little rattled. So look where we end up here. All of our revenues and expenses now zero. Our retained earnings at the beginning was 1,708,000. We had revenues of 1,009,000, which increased it. We had expenses of 904,900, which decreased our equity in the form of retained earnings. And we end up with this balance of 1,904,000. In other words, the 1,090 minus the 904 is our profit. Our equity has now gone up by that amount. They're showing you another way to do this here, and I'm not going to go over it, but that might be another possibility. Well, we closed everything, huh? We closed. The only thing left is to run our post-closing trial balance. After all temporary accounts have been closed, we prepare a post-closing trial balance. Only assets, liabilities, and stockholders' equity will appear. The post-closing trial balance, by definition, does not include revenues and expenses because we zeroed them out. So here we go. Here is the post-closing trial balance before they put any numbers in. Notice that it stops with retained earnings. And there you go. At the end of the month, after we post all of the closing entries, but before we open up for business the next day, you have a trial balance with no revenues and expenses. Because the whole idea of running a business is to take those revenues and expenses, make a profit, and move that profit into retained earnings, okay? This here is just a snapshot in time. It's a split second before your business reopens the next day, okay? Net margin. Here we're starting to get into a little bit about analyzing a financial statement, huh? Net margin, how effective management is at generating profit? If you take your net income and divide it by the sales, you're going to get a number. So let's look at Papa John's. Papa John's had a profit of 103 million on sales of 1,710,000. 103 divided by 1710 equals 6.02% profit. Papa John's earned 6.02%. Another way to say this is for every dollar of sales, Papa John's generates 6 cents of profit. You think that's a good profit? I guess it would depend on the business and the expectation. 6% is,
Yes.
what's that? Say that, Roby?
If you sell enough pizzas, it is.
Yeah, of course.
You sell millions of pizzas.
6%, I think a lot of companies would love to get 6%. What if Papa John's took this 1,710,000 and put it in the bank? They would only have gotten about $17 out of that under today's world. Net profit margin. And then when you're done, you can go out on your yacht, okay? What do you think, Natalie? You have any questions?
No, I'm just trying to follow it all.
What's that?
I said I think I'm just trying to follow it all, taking a little
Okay.
notes.
Yeah, the adjusting journal entries can be a little tricky. You have your daughter with you, by the way?
Yeah, she's watching YouTube.
Would you guys mind? Can I say hello to Millie?
Okay, Millie, come.
We must do this. What do you think, Roby? This is not too tough?
No,
Ha.
but the net income, that can include things that are unrelated to sales though, right?
Say that again. Hi, Millie. Go ahead.
Hi.
Hi, Millie. How you doing? I'm sorry. I got to do my quick act. You ready,
No
Millie?
problem.
Millie? All right, here we go. Hold on. Da, 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 da. Da, 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 da. All right, that's enough of that. Pretty good, huh, Millie? Okay. Roby, back to your question again, please.
Okay, so with the profit margin, you've got your net income over net sales. Net income could include stuff unrelated to the sales, for example, interest or
Oh, of course. Of course.
so.
Yep. Any expenses that you could, as you get further along in the world of accounting, yeah, you have direct costs and indirect costs. Yeah. All of those things go in there. Yeah, the interest has nothing to do really with your ability to generate revenues to some extent, but you did incur that expense during the month, so it has to offset those revenues. Make a little sense?
Yeah,
How about Riley? What do you have to say, Riley?
I'm good. I'm also just following it and taking notes.
Okay, okay, yeah, you guys do your homework. The adjusting entries can be a little tricky. Just try to understand what we're doing here. We're trying to record expenses and revenues that could not be recorded for whatever reason. Okay, either we didn't get a bill, or we didn't pay it, or we didn't know what it was till the end of the month. Okay. Any other questions? All right, I have one more question. Who is worse, the New York Jets or the New York Giants? Anybody have an opinion on that? No? No sports fans there, huh?
don't follow pro football that much.
Well, let's put it this way. If the New York Jets played the New York Giants, I don't think either team could win that game. They both stink, okay?
Okay.
All right, I'll let you go now, okay? All right,
Thank
Millie, you take care. Bye-bye.
Bye.
Hi, Millie. How you doing?
Goodbye.
I need Millie one more time. Is Millie there?